Hello, hello. Welcome to this first episode of Chasing the Deal. This first episode of 2026. We are what's the best way to start the year than investing in real estate? So this episode it's about one of the 8 states that has no income tax. This is Tennessee, and we are going to. I'm going to show you the market of Nashville. We are going to be analyzing the market, the data of the market on CoStar, the intelligence software, and we are going to choose a property to invest in. So if you're ready to go, let's go. Let's find out the information on the market. But before of that, you have a very happy new year, and I hope you have this year full of money and health and love. So for me, it's just to teach you about money, about investment. So let's find out how to invest in Tennessee, in Nashville. So let me show you. Okay. So for you that doesn't know this software yet, I think is the best software out there in the market to research on property, on market information on the properties, and in this software I can see all the information and all the markets in the US, UK, and in Canada. But you can find all the market information, very accurate information, because these people really do a good job collecting all the data on the markets. And for this episode, we are going to analyze Nashville, Tennessee. As I mentioned before, we had in this contest, we had Nashville against Memphis, and both markets are very interesting. Both markets are around one quarter billion square feet inventory uh, for industrial. Memphis has the headquarters for FedEx, but Nashville it's a very interesting market because um, it's very close. I think it's about 3 hours by drive from Memphis, but it's very growing market. I think it's growing at a pace of around 9%. Uh, so it's very interesting. It's many construction going on Nashville, and Memphis. It's more like a stabilized market. It's for the big players, but Nashville, it's there's a space for big players also, but it has also space for small and medium players. That's what I want to talk. Here we see in the first screen in CoStar, we can see a summary of all the data. Excuse me, uh, of all the data of the market. As you see, we have 2,091 million square feet inventory, and we have a growing construction inventory of about 10 million. That's about, let's say, a little less than 5% of the total inventory. So it grew from the last year from 7 million to 10 million. So that's a good sign that something interesting is it's going up there. It's going on. Uh, the net absorption here it's positive. Uh, it it's lower than the last year that was 3 million, but anyway it's positive because in many markets you have seen in previous episodes that the net absorption is negative, but in this one it's positive. That means there are more people moving in than people moving out from industrial spaces. And also we see this number here that is the vacancy rate. It's around 6.5%. um, National average on industrial it's around 9%, so we are under that number. So that's a good sign that this market is interesting. um, and the asking rent also it's higher than the national average. It's almost $12 per square feet, while the national average um, I think it's about 8 or 7 on industrial. I don't remember the number. And the price for the sales it's around 120 124. It went up from the last year from 117 dollars per square feet. So these are important numbers that we can take a quick look, so we can figure out if it's a growing market or it's a shrinking market. Okay, so let's read some things about this market. uh, More than 50% of the leasing space in or the leasing operations here in this market comes from warehouses or spaces, industrial spaces, uh, less than 50,000 square feet. Okay, so that means uh, we are probably see very interesting industrial flex spaces. So let's take a look. Well, we also see bigger companies like logistics companies and manufacturing, but I think the most interesting spaces here are small flex spaces. Why? Because this market it's growing because of companies relocations. Um, I think like 2 years ago, Oracle moved from Texas, or it's already moving from Austin, Texas, to Tennessee, and we are watching many companies moving from other states to Tennessee because, as I mentioned before, Tennessee is one of the 8 or 9 states in the U.S. that has no income tax. So this is very interesting for these companies that are looking for making more money, and also they are looking for to pay to cheaper labor cost. So if they, for example, Amazon have built many distribution centers here because we are close to many important cities on the south that are either logistics hubs or either manufacturing hubs. We are close to Atlanta, Georgia. We are close to where in by plane we are close to Texas, to Dallas, Texas, Houston, Texas, South Carolina, North Carolina. So we are inside a very strategic point to many major logistics and manufacturing hubs. So that's why this Nashville is getting momentum from these big cities and logistic hubs. Okay, so let me show you some other numbers. Like for example, the vacancy rate. Here we can compare against the national numbers. Um, the well, the market asking rent is almost $12. National, it's a little bit more. I thought it was about $9, but I see it's around the same number, 12 uh, per square feet. But in the vacancy, we are under the national average. National average is 7.6%. It's almost 8%, and we are 6% here. So that means we get more money because we have less tenants moving out from our properties. Okay, so availability rate, it's almost the same as the national. And vacant square feet, 17 million square feet are vacant right now. um, Available for sublet, 2.1 million. Available total, 28 million. Okay, so inventory, let me show you. 12-month delivered square feet, 4.6 million, going up. That means a lot of construction going on. We are almost 1 million more than the last year. Okay, sale transactions going up. That means more big players interesting, getting interested in these markets like REITs or private equity funds. So that means we can invest and then we can sell to those big guys. So that's another thing we have to take into account. If we have a secondary market, if big players are uh, purchasing properties also in this market, because we want to purchase, but we want to sell it maybe in 3 to 5 years and take out the profits. So we need to figure out if we have a secondary market or big players purchasing in this market. Okay, so net absorption, 1.4 million. Vacancy, we can see some graphs here also in CoStar. For example, this blue bar is the typical range of the market for the vacancy, and we see we are like 1% more than the out of the range, more in vacancy space. And that's normal for the US because of last year, because of the tariffs. It created some big uncertainty on the industrial markets, and many markets went up on the vacancy. And we are seeing the same thing in Nashville, but it's a big thing because I think temporary end of the administration, we are going to know more about the tariffs. If they remove the tariffs, if they still if they are still in place. But right now, we have some uncertainty, and that's making some markets in the U.S. to go up in some numbers, like the vacancy. Okay, so Nashville is not the exception here. Um, the market asking rent growth, it's also on lower levels from the, for example, in the 2021, we had a 10, almost 11%, 11% growth in rent year over year. But right now we have only 1.1%. But we are still growing in rent. Okay, so I think it's for example, market asking rent. We are on the on the highest levels. You see this timeline. For example, on the 2023 third quarter of 2023, we were 10.78, and right now we are 11.75. So that's almost $1 more, or 10% more than the last year. Good sign. this is a good market. Okay, leasing. mm, Let me show you some. For example, we can see the forecast here for the vacancy in the United States and the vacancy in this market, and we can see a little bit jump to 6.5% at the end of 2026, and then going down from there to 2030 to 5.9%, but almost steady. So if we build or we invest in this point in the first quarter, second quarter of this year, we can forecast uh, what will be the numbers at the sale, at the exit of the property. So CoStar also help us with forecasts like this, and we see like good numbers here. For example, the net absorption, net deliveries. We are seeing the net absorption growing at the same pace of the net deliveries. Okay, so we are not seeing or we are not forecasting an over construction in this market, because if we see uh, net delivery is growing more than net absorption, we can expect then the rents to go down, or maybe the vacancy to go up, and that means less cash flow for us. And if we have less cash flow, then we have a lower value for the exit, for the investment. Okay, but in this case, we are seeing a little bit less vacancy, so that means uh, our numbers at the end of the or the exit of the holding of the property will be better than when we make the investment. We are seeing the vacancy decrease. Okay, and we are not seeing an increase on a decrease on net absorption or an increase on net deliveries. So we can forecast, we can say at this moment we can say uh, the investment is will be a good investment. Okay, net absorption, we see, for example, we see a drop here in the second quarter of 2025. Okay, but then we have a positive absorption on the third quarter and the fourth. Okay, leasing activity. Okay, okay, we see here, for example, in the 2025, a little bit less leasing than the number coaster forecast, but that's not a big deal. Okay, because the other numbers are good. Vacancy, we see, for example, here specialized is mostly manufacturing, uh, and we can see all types of industrial going down from the at we have a peak at back and vacancy in the end of the 2026, and then all types of logistics specialized on flex, all types dropping from the peak of the vacancy at the end of the year. Okay, so if we make the investment uh, this then we can see a drop at the exit of the investment. Usually when you purchase a property, I don't recommend you to, at least if you make an investment with the core or core plus strategy, that is just hold it, take some debt, and just wait until the property appreciates. if you are making a core or core plus, I recommend you hold at least 3 years. But I mostly recommend 5 years because uh, if you are in a growing market or even in a stable market, uh, most of the chances are you are gonna have a profit uh, if you hold it for 5 years and you take debt. It's very important to take debt because that way you can leverage and you can minimize your investment and you can take the leverage and multiply your return over investment. Okay, if you are doing the core strategy or the core plus. But if, for example, if you are developing, you can develop from as fast as 1 year, maybe 1 or 2 years, and then you can sell at the end of the second year because you are adding value. You are not relying mostly on the market for the appreciation, but you are making the appreciation directly by your own resources. Okay, because you are building something new, or maybe in the value added strategy you are renovating something, but anyway you are adding value. So if you are adding value by yourself, you exit in maybe 1 or 2 years. But if you are only relying to go up, I recommend 3 years. Usually you can hold it maybe 10 years. Okay, but not too long because also if you wait too long, the property starts to you start to get from problems from the property, from the maintenance side. And also if you hold it too long, the cap rate also decompress, go up because the property gets sold. So the investors are not willing to pay you more because the property gets sold and start to make problems with the maintenance, and then the cash flow is less. It starts to compress, to shrink. Okay, vacancy, availability. Okay, let me see some important numbers. Months of market in Nashville, around 6 months to sell industrial properties. That's normal. That's in line with the market. Months to lease, 4 or 5 months to lease. So these numbers are important if we are analyzing the property and we are finding how much are we paying for the how much are we paying for the interest, for the interest on the loan. Okay. Okay. Let me see, because I don't get any power from here. Okay. I hope I'm not get out of battery because I don't think my computer is charging. I don't know why. Okay. Okay, we are good now. Okay. So let me show you market asking rent. I'm trying to find the cap rent. This number is also important. Asking rent per square feet in Nashville, average at the end of 25, it's or start of 26 is $12, $11.83 construction, some construction going up. 2 million square feet at the end of the 2025. The deliveries, we see 2026 deliveries 2 million, 2.3 million, and net deliveries 2.2 million. Okay, we see a little bit piece of that number. It's demolished properties, so that means we have plenty of space in Nashville, because otherwise if we see the deliveries, um, the demolished properties, it's the same as deliveries, or very similar to deliveries. That means we are in a mature space. So we want to, in a mature space, in a mature market, like for example New York, we have to purchase old properties and then demolish, have more space to the suburbs or to the skirts of the city. uh, we will be too far away. So that means Nashville is a small market, and we still can find some land, um, in the some cheap land in the close to the populations, to the neighborhoods, or to other industrial parks. Okay, okay. So I want to. Okay, this is the market coverage. Okay, in Nashville industrial, we are having around six, maybe at the start of 26, 6.6%. Okay, so as you can see, the national average, it's more, it's around 7.3%. So that means investors are paying more in Nashville than in the national, in the other markets in the U.S. because I find it interesting. This market, they are finding profitable market. That's why they are paying more for industrial properties here. Okay, so let's go to find some properties. Now that I showed you the map, we can go see some properties for sale. And as I told you, because this market is growing mostly of the relocations of other companies, it's similar to what's going on in Dallas, for example. So when you have a new company moving to a new state, then you have people moving to work on that property, especially if those are labor intensive companies. We can expect many people moving into the to Nashville. So that people are usually they want doctors, or they want dentists, or they want or maybe they make new business, and those business need services like something for the construction services, or yard services, or many business services, cleaning services. So those kind of services, they need space, they need industrial space, because usually it's the cheapest space by square feet for a business. It's industrial. Because if you have, think about it, if you have a construction company, you don't go to a shopping center, to a shopping mall, you know, or some like an office, because you need some construction requirement. And one thing, the space will be very expensive, and the other thing, you need to put some machinery, some things you need, like for example, cement, concrete or something, or for example, if you are in the roofing business, you need your materials for the roofing. So you will not go to a retail or a shopping mall. You will find a flex building, an industrial building. What is a flex building? A flex building is something that is between the warehouse and an office, because in a warehouse you have very high clearing, because you stock many things. In a manufacturing building, you need many, for example, you need many doors. Okay, you also need a high clearance, and also you need very strong structure, so you can place on machineries. uh, but in a flex building, you only need some machinery, some materials, but you need some office space. So usually flex space are like 30% office and 70% warehouse. Okay, and it's usually, sometimes uh it's cheaper than office, and it's you can subdivide the smaller spaces in flex, because in for example in warehouses, you will be renting, you will be leasing space. Okay, so let me refresh this, because I think, okay, I don't see any data here. Let me Nashville. Let me find some properties. I don't know why my internet is not well. I don't know what's going on here. Okay. 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 So if you have a small construction business, you need a small space. You don't need 100K square feet. You don't need a high clearance space, but you need some office space and you need some small warehouse space. So that's what flex space solves for this small business. So if big companies are moving on to Nashville, they are there are people moving on that economy, on that city. So that so services and flex spaces. So we are flex spaces here in Nashville, because we can expect demand for these spaces, and also the market data and CoStar confirms this, because most of the transactions are under 50K 50K industrial spaces. Okay, so let me find Nashville properties. Okay, and then we are looking for properties for sale. Okay, And okay, again, Nashville. Okay. Um, I don't know why it's in Spanish right now. Um, okay, I think this is flex. Okay, this translates in Spanish, and I don't know. Maybe it's because right now I'm in Mexico. I usually have it in English, but these are the flex spaces here in Nashville, and let me filter up by square feet, and we are going to filter under 50K. Okay, so we see some properties at the south, some properties at the southwest, but most of the properties we see are on the north. And also in the market report, I think I didn't show you, but most of the transactions for properties under 50K square feet are on the north. Okay, because for example, if we want some connectivity with Atlanta, we may look for properties on the southeast. Okay, but I can think maybe this most of these properties are bigger than this number, are warehouses or manufacturing, because of the 75. I think is a 24 connectivity with Chattanooga and with Atlanta. With But we are not looking for connectivity with other cities, because we are looking for flex space. Okay, we are looking for we are looking to be close to the people, to the suburbs. Okay, or maybe to the business. Most of the big business corporates are on the downtown. Okay, and most of the suburbs, I think, here in Nashville are on the north. So let's find a point in the middle from the north and in the downtown. So let's choose properties. Maybe I think this is a good point. We are close to one highway, so we have access to the downtown, but we also have access to some suburbs. Okay, if we have a roofing company, we want to be close to the houses. But if we have a business cleaning services, we want to be close to the downtown. Okay, so let's choose something in the middle. Let's choose this one. Okay, let's select. Let's choose, because we are here in the highway 31, and this one, it's for sale for 2 million. Okay, 9,000 square feet. I think that property is not good. It's too expensive. Let me choose this one. Uh, 215, 10,000 square feet. Okay, let's choose this one. 1.1 million, 5,000. Damn, these properties are expensive, but well, let's select this one. Okay, let me see this one. 3.8 million. Damn, these are. You can see when a property is expensive by the days on market. As you see, the average days on market for this for Nashville are 6 months, but this is a little bit more now. So let me see more. 1.1. Wow, these properties are very expensive. I don't know why. Let's go to the south, to a little bit more to the south. Mm, 4 point. Wow. This is multifamily. Why I'm seeing a multifamily here? I'm looking only for flex. Okay, let's explore the south. Okay. Flex. Okay. Let's select this one. No price. Okay, let's select this one. And one property at the north. Okay, this. Let's select this one. Okay, so let's vote for these three properties we have selected. So we have this one. 1.1 million, 3000 A.S. Dickerson Road for 5,000 square feet here at the north. And then we have two properties at the south. Where are those? Oh man. I lost those properties. Okay. Let me select again. Okay. Okay. Is for sale. Flex properties. Property number one. We have 10,000 square feet property. We don't have a price here. Then we have 3530 Dickerson Pike for 2.5 million. 8,000 square feet. And the third property we have 7,500 square feet, and they are asking 3.8 million. Which one you want me to analyze? Okay, you can comment on the chat. Okay, let me see the comments. Okay. Okay, so first property, 10,000 square feet. We don't have a price here. Then second property, 1,000 square feet for 1 million. But I think we have a nice piece of land here. And third property, we have 75,000 square feet. Okay. Which one do you want me to analyze? Let's choose one property. I'm gonna wait 1 minute for the comments. Property number one at the north, 10,000 square feet, no price. We're gonna figure out how much we can pay for that property, for the property we choose. Second property, 1.1 million for 1,000 square feet. Okay, it's too small, that property, I think, but anyway. And third property, 7,500 square feet. They are asking 3.8 million. Okay. So which one you want me to analyze? First, 10,000. Second, 1,000. Third, 7,000. Which one? Very, very high priced properties, I think. I really think. But let's figure out how much we can pay for those. Because here we are not, we are looking for core strategy, maybe core plus. The difference between core and core plus, it's maybe in both properties you don't have to do much, like renovations or ground up construction. But for example, core properties maybe new, and maybe cash flowing, but maybe core plus property maybe also new, but maybe vacant. So you have to list it up. That's the difference. Or maybe the rents are lower than the market. Both our properties are new uh, or are at least they don't have to be new to be core, but at least they are cash flowing, and you don't have to make any major improvements. Okay, so the difference between core and core plus, it's the rents most of the times. Maybe the rents are lower than the market rents, or maybe the property is vacant at all, or maybe they have like 3 units and 1 unit is vacant. So that will be a core plus. Okay. Okay. So let's choose then this first property. A price here. So we have to call. We have to call and ask the price, but we are going to figure out how much we can pay for this to be a good investment. Okay. Let me see if I can. I don't know why this is displaying in. Okay. Okay. I can see. Ah, I don't know why I see in Spanish. It's frustrating, and I don't see any information on this property. So okay, so I'm gonna try to share with you other document. Let me see if I can share. Um, okay, okay. This is a flyer for the property. Okay, this is a tire company and gross rentable area 1900, rent per month 4000, term month to month. Okay, okay, we have three properties here. These are three lots, I think. One, two, three. Okay, so that means this may be good because we can purchase the portfolio of properties and then we can sell one property, and then if we need to do some improvements in one property we may get some money to make the improvements. Okay, so the first property is 19, almost 2000 square feet, and the rent we they are rented out for 4000. Okay, second is almost 800 $8,000, and they are renting for 10,000 dollars. Okay, and the third one, they are it's a food truck. Okay, and they are renting for $4,000. Okay, okay, so we have all the numbers for the rent. So I don't know if this is a triple net lease because it doesn't say anything about the type of lease. But as you see, it's mostly like a retail location. I think it's zoned for retail because they have a truck, a food truck. Okay, but they listed as a they listed as a flex building because I think the second property it's a flex, but the first property, yeah, it's mostly like a specialized like a tire shop, maybe retail, and the third one is retail for sure. It was like a gas station. Okay, so let's find out how much. This is an easy way. There's an easy way to find out how much to pay for a cash flow property as this one, and that's dividing the net operating income dividing by the cap rate. Okay, so let me make some fast calculations. So we know we have 4,000 per month in the first property plus 10,000 on the second one, and then 4,000. Let me see, 4,000, 10,000, and 4,000. So we have $18,000 a month per month for the three rents, and then we multiply by 12. So we have we have $216,000 for the three properties annual gross rent. But I suspect this is not a lease rent, a triple net lease, because I see the tenants are retail, mostly retail. So if it is a triple net lease, like most of industrial leases, that means the tenant will pay for maintenance, property taxes, and insurance. Okay, but since this is a retail, I'm not sure. Some retail pay net lease, triple net lease, and some not. Uh, some are just gross leases. So let's assume these are gross leases. So that means from this number, $216,000, we have to pay those expenses: the property taxes, the insurance, and the maintenance. So usually with this property, this is not a new property. So the percentage we pay for for expenses in these all properties are between 40 to 50%. So let's say it's 40%. Okay, so that means we have to multiply this 216,000 by 60%. Okay, because uh, we subtract uh, 40% from one, and then we have 60% that's or net income. Okay, so in that case, we end up with $129,000 net income. So now we have our net, we have to divide by the cap rate. And we already know the cap rate in this market is between 6.5 to 9%, but 6.5 are in the brand new industrial properties. So I suspect this property will be around the 9%, because the higher the cap rate, the higher the risk for the investor, and the lower he wants to pay for the property. So let's say the cap rate here is 9%. So we have to divide $129,000 and $600. We divide by 9%. So the number we have to pay for this property with that assumption is 1,440,000. Let's say 1.45 million. Okay, so I don't know why most of these small properties, they are this property has no price, but most of those of the other properties had very high prices. Okay, so you always have to calculate, to analyze and calculate the actual price you are willing to pay for the property. In this case, as you can see here, you don't have plenty of space for value add improvements. These are all buildings. Maybe you can follow other strategy like ground up strategy. I suspect you have to rezone, have to build something else, multifamily or something else, or maybe retail if this is zoned retail. But if you are going to purchase this property as is just for the cash flow, you have to pay at most 1.5 million. Okay, so if you like this video, I hope you find this market interesting. As you know, every episode I analyze any market, a new market in the US. So if you want to see more markets and you want to get notified every time I make a new live, uh, subscribe to my channel in YouTube. I'm Nearshoring Team, or you can follow me, or uh, follow my LinkedIn company page at the Nearshoring Team, or you find me on LinkedIn as Andres Vite. And well, subscribe to my channel, give me a thumbs up, comment if you have any comment. How would you calculate the value of the property, or maybe you will follow other strategy in this property? Write on the comments. I will answer back your question. And if you want to purchase an investment property, an industrial property here in the US, I'm a real estate agent. I can help you. Just send me a message on LinkedIn or call me. I have my number or my contact form on my website. It's the nearshoringguy.com, and I will leave you my link on the description on YouTube and LinkedIn. And I hope you like it, and See you in the next episode. Thank you for watching.